In this video, I'm going to go over the Chapter 8 Foundation 15 problem on master budgeting. And we are given information about Morgantown Company. They make one product, and the following information is given related to that master budget. So we have information that the selling price, the budgeted selling price is $70, and that the budgeted sales for June, July, and August and September are as follows, and that all sales are on credit. So that's important because then when we do the cash receivables budget, we need to consider the order in which this credit is collected. It says that 40% of credit sales are collected in the month of the sale, and then 60% in the following month. So this will affect those sales that I just referred to, at least the collection of cash of those sales. The ending finished goods inventory equals 20% of the following month's unit sales. So we produce more than we need each month, and what we produce is 20% of what we expect to sell next period. The ending raw material inventory equals 10% of the following month's raw material. So same thing, but this is dealing with raw materials as opposed to the finished good. Each unit of finished good requires 5 pounds of raw material, and each pound costs $2. Also given is the information that 30% of raw material purchases are paid for in the month of the purchase, and then 70% in the following month. So this affects accounts payable and the order in which we pay accounts payable. So we'll keep that information in mind. And then the direct labor wage rate is $15 per hour, and each unit requires 2 direct labor hours, is what they're saying. Finally, the variable selling and administrative expenses per unit are estimated at $180, and the fixed selling and administrative expense per month on a total basis is $60,000. So this $60,000 will be broken apart and allocated to each unit that we produce. All right, so let's go ahead and run through this real quick. So under number 1, we're being asked to prepare the budgeted sales, or the sales budget for July. Now, it's not a coincidence that we're starting with the sales budget, as all budgets really begin from an estimated amount of sales. Until we have some expectation of what we're going to sell or how much revenue we're going to generate, we really don't know what kind of resources we need. So many times the marketing folks will go out there and they will perform tests and give us information on what they expect the sales volume to be, and based on that information then we can start our budgeting. So we are told that in July the sales level is expected to be 10,000 units. Okay, so I'm going to put in here expected unit sales of 10,000 units, and then the selling price that they gave us is $70. And all of this information, of course, is based on expectations, right? This is what we expect, but this is not always how it comes out to be. So this is the sales budget for July. Let me put some dollar amounts on this. There we go. So based on this information now, then we go in there and say, okay, if I expect to sell 10,000 units, then I need to manufacture, or at least have in inventory, 10,000 units for the month of July. Okay, so keep that in mind. Also, whenever I sell this, recall that I don't collect all of this in cash. Remember that the sales are on credit, and then they told us that 40% is collected in the same month, and then 60% in the following month. So that's very important to know, because you might run out of cash before you can even continue making more units, right? So you got to estimate that. Let's go to number 2. Number 2 says, what are the expected cash collections for July? Okay, good. So I'm going to go in here and I'm going to say expected cash collections, July. Okay, so if we have sales from July of 700,000, okay, so I'm going to put a line here from July. I have the sales amount of $700,000. I'm just going to copy this, and then expected collections. Actually, let me put one more. Well, that's fine. Let me leave that. So the expected collections in the same month we said were 40%, which means that the expected cash is going to be this times that. So in other words, out of the sales in July of 700,000, we expect to have in cash $280,000. Now, June, we also had sales, right? So we're going to collect some from June as well. Because recall that the sales are collected 40% in the same month and then 60% in the following month. So now we're going to be collecting 60% from June. Okay? So now we got to determine what were the sales volume in June. In June, we sold 8,400 units times $70. Okay, so 8,400 units were sold in June at $70 each. We sold $588,000. 40% of this was collected in June, and then 60% now is collected in July. So what this means is that out of the sales in June of 588, 352,000 is collected in July. Okay, because remember, we're doing the expected cash collections for July. So we will sum this up, and we would say that the expected cash collections in July from sales is 632,000. So look at the sequence of events here. This is the expected sales level, right? I'm going to have expectation of 10,000 units that I need to have available for July. Further, I'm going to look at the expected cash collections of $632,000 roughly. I will tie these two in together in the sense that I gotta ask myself, can I make these units, or can I have these units available given the inflows, the expected inflows of cash that I'm going to have? And that's key, okay, because you're not collecting everything that you sell. You're not collecting the cash immediately, so there's a delay there, and that's where you have to be very careful. All right, third item, the question is, what is the accounts receivable balance at the end of July? Well, let me write this down. Ending balance for AR July. Recall that in July we started with $700,000, right? Because we sell 700. Of that collected in July was this amount, 280,000, because that was 40% of those same sales. So the remaining, you could have just done 60%, which is the complement if you want, but the remaining ending balance is going to be that difference, okay, which is $420,000. At the end of July, we will have an AR, or accounts receivable balance, of $420,000. There won't be anything from June, because recall that the remaining balance of June will have been collected by the end of July. So the only thing that remains in accounts receivable as an asset to be collected is this $420,000. Okay, so let's go to number 4 here. According to the production budget, how many units should be produced in July? Okay, good. So recall, well, let's call this one the expected production budget for July. Recall that we expect to sell 10,000 units. Okay, that's this year. So that's, this is what July expectations are in terms of sales. So at a minimum, we need to produce 10,000 units. Okay. Further, they did tell us that they would like an ending inventory of 20% of the following month's expected unit sales. So in other words, we're not just going to produce the 10,000 that we expect to sell. We also want to add any desired ending inventory. So in this case, for August, the expected sales are 12,000 units. Well, we're going to produce 20% of that, because at the end of July, we want to have that already ready to go. And that's going to be, so let's go ahead and do that, equal 12,000, the expected sales in August, times 20%, which is per company policy what we want to do. So what does that mean? It means that we need to produce, or we need in total, okay, production needed. Let me expand this column here. It's going to be 12,400. Okay. Now, if we had no inventory from last month, then this is what we would produce. But a lot of times we're going to have already some existing inventory. So I'm going to subtract any existing inventory, because if it's already there, then we don't need to produce it. Now, the existing inventory would have been the ending inventory from June. Okay, so don't get lost in all these dates here. Back in June, when we wanted to do the expected production, we estimated 20% of July's expected sales. Okay, so that ends up being our beginning inventory in July. So let me recap that again. In June, we produced extra units, and the extra units we produced in June were this 10,000 times 20%. So in other words, we already have that in inventory, so we're not going to produce that. Just like we're now, it's similar how we're now adding the 20% for expected sales in August. So this will be the beginning inventory in August. In the same way that now these 2,000 units are the beginning inventory for July. So those we don't need to produce. So that's where the expected budget gets an adjustment there. So our required production or expected production in July is going to be 10,400, because we don't need to produce those. Okay, so look at the sequence here. We figure out what we expect to sell. Based on that, we can see more or less what our expectations in terms of cash inflows for that month are. And based on that, then we say, well, to achieve that sales level, then I need to produce 10,400 units. And you start thinking about whether this amount of money you're going to be collecting is enough money to cover the resources to make these units. Okay, so let's move on to number 5 here. And now that we know how many units we need to produce, let's look at the resources needed to produce those units. So question number 5 says, if 61,000 pounds of raw material are needed to meet production in August, how many pounds of raw material should be purchased in July? Well, really what we're looking for is what is the expected raw materials to be purchased, right? So expected raw material to be purchased in July. Okay, now they're giving us forward-looking information. They're telling us that we need 61,000 pounds of raw material in August. And the reason they're giving us that forward information is because of the fact that they told us here The ending raw material inventory that we would like to have is 10% of the following month's raw material. So in other words, I'm not just going to buy raw material for this level of production. I'm also going to buy a little bit more for what I think next period I need. So we need 61,000 pounds for next period, so we're going to buy an extra 10% of that. And you'll see how that works out in a minute here. Okay, so my required production is the first thing we'll start out with. I'm going to make 10,400 based on the expected production budget from July, just above here, number 4. So then the next question is, how many pounds or how much raw material? I think it was in pounds that they said, or let me see. Each unit of finished goods requires 5 pounds of raw material, correct? And it costs $2 per pound. Okay, so I'm going to go in here and say pounds per unit, and that's 5. So the units, the raw material units for required production. I'll try to use the same verbiage here. In other words, for this level here of 10,400, I'm going to multiply that and tell you right now. I'm going to need this many pounds of raw material. Okay? Now, that's what I need to meet the current production of 10,400. I need 52,000 pounds. But keep in mind that I'm going to buy more material because, like I said a few minutes here earlier, we want to have 10% of what is needed for the following month. So they were nice enough to tell us that they need 61,000 next month. So we're going to add the desired ending inventory. Oops. So add desired ending inventory of raw materials. So don't confuse these two here. This was the desired ending inventory for finished goods, the actual units themselves. Whereas here, now we're talking about the raw materials needed for those finished goods. So this was going to be 10%, let me write that like this, 10% of 61,000 pounds. Okay, so that is going to be 6,100 pounds. So total raw material needed is going to be the summation of these two. So far what this means is we need to go buy 58,100 pounds of raw material. Okay, so to meet current production and to meet the desire to have some extra inventory at the end of the period and inventory of raw material. And then just in the same way that we subtracted out the existing inventory, we also have existing inventory for raw material. So less existing raw material inventory. And that should have been 10% of what we were going to use in July. So in other words, in June, we were foreseeing that we needed 52,000 pounds of material. That was in June, okay? So in June, we bought 10% of that already. So technically, that's already an inventory. So we don't need 10% of this because that was already purchased in June. Okay, so we're going to subtract this out. And maybe I should put this as a negative here, just to be more clear. And then this as well as a negative. In other words, what I'm saying is, bear with me here while I do the, okay. So what I'm saying here is this existing inventory, that's stuff we don't need to make. The existing inventory here, that's stuff we don't need to buy in terms of raw material. So the ultimate balance here is required raw material for production, or not for production, let me rephrase that, to be purchased. And the reason I want to rephrase that is because this is the raw material we need for production, 52,000 pounds. But this is the required raw material that we need to buy for the month of July. So that's going to be the summation of these two, or the netting of these two. Okay, so the budget calls for 52,900 pounds to be purchased of raw material. So I assume the next one is going to have us calculate how much that is in dollars. This is number 6. What is the estimated cost of raw material purchases? All right, so naturally 6 just follows. If I need 52,900 pounds, in each pound, cost per pound is $2, then I'm just going to multiply that and expected cost of raw materials for the month of July. Let me put a dollar sign on this so that we know that now we're talking about dollars. So the expected cost of raw material in the month of July is $105,800. Okay, so very important to keep track of the fact that you're going to be spending $105,000 right here, and your expected collections during that month is $632,000. Okay, so now that we know what the expected cost of raw materials are, then in number 7, we're going to estimate the cash disbursements for raw materials. So let's go in here and say expected cash disbursements for raw material in July. So maybe I should have been a little bit more clear. This technically is not the amount of cash we're going to spend in July, okay? Because of the fact that some of this raw material we buy on account. And I think I misspoke by saying, that if we're going to collect $632,800 in July, that this is the amount that we're going to spend in raw material. And that's not completely right because of the fact that this material we buy, but we buy it on account. And if you recall, they told us that 30% of raw material purchases are paid in the month of purchase. So in other words, in July, we're only going to pay 30% of this as cash outflow, and then 70% in the following month. So in July, we're going to be paying 70% of the purchases from June, and that will be our cash outflow, those two items. So let's go ahead and do that so you can see what I'm saying. They tell us in number 7 that in June, assume that the cost of raw materials in June was $88,880. Okay, so the from June purchases, okay, we're going to pay 70% of those. Okay, so 70% gets paid in July, the month afterwards. So if we bought $88,880 worth of materials in June, in July we're going to be paying 70% of that in terms of cash outflow. Okay, and that's $62,216. Now, we're also going to be paying from the purchases of July, and that's going to be 30% of the July purchases. So that will be this amount times 30%. Okay, and then these two values are the cash outflow, to be more precise. So let me sum these two up, and it's going to be $93,956. So it is this number that we need to compare to the inflows. So if $632,000 are what we expect to come in terms of cash sales, then in terms of raw material, we need to say, okay, well, 93,000 of that is already committed to purchases of raw materials. So I'm going to put here expected cash disbursements for raw material. Now keep in mind, this is just raw material, right? We have many other things. Now, in question number 8, they want to know the ending balance for accounts payable in July. And I'm assuming this is the accounts payable balance related to raw materials only, okay? So 8, expected or ending balance of AP, accounts payable, in July. And we're assuming, that's a big assumption, assuming that only raw materials are purchased in AP. Because normally many other things are purchased through accounts payable, right? But here we're just going to say, well, we made purchases of 105 in July, of which we paid 30% of that. So the remaining AP balance will simply be the difference. So I'm going to copy the expected cost of the material. Oops, sorry. So that's 105. And then I'm going to subtract from that what we pay from July. We paid this, giving me an ending balance for AP in July of this amount. So I'll subtract this out. So at the end of the month of July, our AP balance is expected to be $74,060. Now, I haven't been completely consistent with writing the E here, the expected or estimated, and really I try to emphasize that a lot because this is all based on expectations, right? It all starts from an expected sales of 10,000 units. If this changes during the month, then a lot of these things are going to change as well. So everything is based on expectations. And that's why it's so important to do good market research and understand what the market is receptive to in terms of our product or service, right? And it's never a perfect science. You know, we expect to sell some units, and it may end up be that, or it may not be. And so we always have to be flexible because these are all expectations. Okay, so let's look at number 9. 9 says, what is the estimated raw material inventory balance at the end of July? Okay, so the raw material inventory balance would be the dollar amount that we think we have left over. So recall that in terms of raw material, we purchased what we needed here, right? And then we added 10% of next month's amount. So what that means is that once July passes, we should have this amount left over of raw material, this amount of pounds. So I'm going to put in here 9, and this is going to be the ending balance of raw material for raw material account in July. Okay, so I'm going to copy this. We wanted this to be extra, right? We wanted that 61,000 to exist at the end of the period. So that's what will be left if expectations work out perfectly, right? And then the cost per pound, we said was $2. So the ending balance of raw materials in July is going to be the multiplication of that. We will have 6,100 pounds physically in inventory left over. At least that's the expectation. And that corresponds to a balance in the account of $12,200. All right, so now that we've analyzed raw materials, okay, when you make a product, you have direct materials, direct labor, and overhead. So we've analyzed direct material. So now let's look at direct labor. And direct labor is easier because you can't store labor in the same way that you could store materials, right? So, and that makes it easy for the calculation. And let me show you what that means. So number 10 says, what is the total estimated direct labor cost for July? Assuming the direct labor workforce is adjusted to match the hours required to produce the forecasted number of units. That's a big assumption there, because sometimes we don't have that flexibility. In other words, we have to pay our employees for 40 hours many times, whether we produce one or whether we produce 10,000 units, whatever the case may be. In the short term, of course. In the long term, if you're only producing 1 unit per period, of course, that's not sustainable. But here, what they're saying is, we can adjust the labor. This is sort of like contracted work. If we have X amount of units to produce, then we'll hire just enough to make that. Okay, so we'll call this one the direct labor budget for July. Okay, so the first thing we need to include here is how many units are we going to produce in July. So let's go to the expected production budget. And we need production of, right here, 10,400. Okay, so from this budget right here, we get the production amount. So let me copy this. This is B24 and C24. Equals C24. So if I'm expecting to produce 10,400 units, then we need to know how many hours per unit are needed in terms of labor. And they tell us the direct labor wage rate is $15 per hour, and each unit of finished good requires 2 direct labor hours. So I'm going to go in here and say direct labor hours per unit is 2. So overall, direct labor hours needed is going to be the multiplication of those 2. Okay, so I need to hire enough personnel in the month of July to meet 20,800 hours of labor that I need. Okay, so those are hours. Now, the next question is, how much do I pay them? Direct labor costs per hour, and that was $15. Okay, and I'll multiply that, and that gives us our budget. And the reason it's, I said earlier, and I want you to appreciate this here. I said earlier that direct labor budget is usually easier because of the fact that we cannot add or subtract existing inventory like we do with direct materials. We can add some extra raw materials, subtract out some stuff from inventory, but with direct labor, there is no such thing as human hours inventory. It's whatever you have available, and in this case, we need this amount of hours, and that's what we're going to pay. So you don't have to do those adjustments like we did for direct materials. So this is the direct labor budget for July. And we'll multiply that out. And we can expect to pay, in terms of direct labor, $312,000. Now, I'm assuming that we pay as the employees work. Sometimes there's a delay, right? Sometimes there's a 2-week delay in payroll, which could buy us 2 weeks of cash flow needs if needed, right? But right now, what we're thinking is the expected cash inflows for July are $632,000. Of that, the disbursements for raw material are going to be around $93,000. And then the disbursements for direct labor are going to be around $312,000. So we're keeping an eye on the cash flow because that's key. If we run out of cash, we can't produce, we can't hire people, and everything just goes downhill, right? So cash flow management is very important. Okay, so now we've estimated what material purchases will be and what we'll pay in direct materials. We've also estimated what we're going to pay in direct labor. So naturally, the next one is what we're going to pay in overhead. We have to come up with an estimate of that. And usually we have, as you learned in previous chapters, a predetermined overhead rate to be able to estimate this, right? So we might not go into the details of that, but do understand that that would be the natural process if you're trying to manage cash flows. What are the expected overhead items that we're going to be incurring? All right, 11. 11 says, if we assume that there is no fixed manufacturing overhead and the variable manufacturing overhead is $10 per direct labor hour, what is the estimated unit product cost? Okay, so let's go ahead and look at this in the same way that I was just discussing this, right? So we have these are the factors of production, direct materials. Each per unit. So each item consumes 5 pounds of raw material, and each one of those pounds, if you recall, costs $2. So in terms of direct materials, we're spending $10 per good. Okay, so this is 5 times 2, and that's $10. Let me put a dollar sign on these. Then direct labor, we were told that each item takes 2 hours, and we pay $15 per hour. So that's going to be equal to 2 times 15. And again, that's $30. And then finally, they simplified this. They told us that the rate to apply overhead is going to be $10 per direct labor hour. So since we've dealt with the determination of predetermined overhead rates in the past, we're not making that an emphasis right here. So we're being told what the rate is. So just assume that the predetermined overhead rate is, they did it for us. They did that calculation, $10 per direct labor hour. So naturally, we know that there's 2 hours of direct labor. Okay, we knew that here. That's 2 hours. So we're going to apply 2 times 10, the overhead rate, which is $20. So our estimated cost per unit is going to be $60. Okay, there's our final answer for 11. Number 12 says, what is the estimated finished goods inventory balance at the end of July? Okay, so let's go ahead and look at that. Estimated ending inventory in July. If we go back to the original sales forecast here, where we wanted to make 10,000, and then we did the expected production budget, where we said we need to at least make those 10,000, and then we added a desired ending inventory for finished good of 2,400. That's what we're going to have left over in finished goods at the end of July. So that 2,400 is ending inventory of finished goods in July in units. That was 2,400 from before. You know, remember, we planned that ahead of time, so we wanted to have these extra 2,400. So naturally, at the end of the period, if everything goes according to plan, we will have 2,400 units left. And each unit cost us $60 is what we estimated. So that's just what we did from right now. Well, that means that our ending inventory, we emphasize estimated ending inventory in July, will be this multiplication of that. $144,000 is what we will have as an asset for finished goods inventory. Now, 13 asks us, what is the estimated cost of goods sold and what's the gross margin for July? Okay, so let's go ahead and do those two. So estimated cost of goods sold and gross margin for July. So I'm going to go in here and say sales, estimated sales. Recall that in July we expect to sell 10,000 units at 70 each. So our expected sales is $700,000. That's C7. So this we already did. This is equal to C7. And then our cost of goods sold, so estimated cost of goods sold, is going to be equal to 10,000 units, those same 10,000 units that we're going to be expecting to sell. times the cost per unit of 60, this right here. Okay, so that's $600,000. So I'm going to remind you that these 10,000 units that we're selling is the number of units that we use for the cost of goods sold. Do not use the required production, do not use anything else. If you're preparing the income statement is always going to be based on the number of units sold. No matter how many you produce, no matter how many you keep in inventory, it's always based on the number that you sell, right here, 10,000. Okay? So our gross margin, and I'm going to skip the estimated, but we understand that that's all estimated, is going to be $100,000. Our, oops, I did a mistake here. Our expected gross margin in July on the income statement is going to be $100,000. Okay, so now we go to question number 14. What is the estimated total selling and administrative expenses for July? Again, this is on the income statement, so this is based on sales of 10,000 units. So let's go ahead and do that. Estimated S&A expenses for July. So let's go back to the original data here. And if you recall, they told us that the variable selling and administrative expenses is going to be $1.80 per unit sold, plus the fixed amount of 60,000. Okay, so we're going to go in here and we're going to start with expected sales times 180. So that's going to be 10,000 times $1.80. Well, you know what? I should be more specific here. This is the expected variable S&A expenses, which is 10K units sold times 180. That's how I should write it. So that's $18,000, okay? Plus the expected fixed S&A expenses, and that was just $60,000. That was given. Okay, so the total estimated S&A expenses for July are going to be the summation of those two. $78,000. So we're slowly creating all the inputs that we need for our income statement, if you notice that. Because we have the amount of sales that we think, the amount of cost of goods sold, and now we have the expected selling and administrative expenses. All right, so now 15 is our last one here. What is the estimated net operating income for the month of July? Okay, so let's go ahead and scroll up a little bit here. 15 estimated net operating income for July. So we knew the gross margin here, so I'm just going to copy this down. So this is the upper part of the income statement. Oops, this did not work out. Let me do that again. I'm just going to copy the values instead of everything there. Okay. So this we did already. And then from that $100,000, we're going to subtract the $78,000. I did that again, I'm sorry. Let's just put the values. There we go. So that our expected or estimated net operating income is going to be roughly $22,000. And this is all expectations, right? So be careful. Make sure you understand that. But you know, some would argue, why go through this process if this is all expected, right? We don't know if it's going to be for real. Well, it's an exercise that needs to be done, because if we have a system where we can estimate things ahead of time, and we have a reliable system that we've used before, that we're trying to perfect, then this is a worthwhile effort, especially, in my opinion, and I don't think the chapter drives this point across a lot, especially in terms of cash flows, okay? So, you know, you can look at this and say, well, you know, this is my income statement, right? And I expect to have net income of $22,000, net operating income. And that's good, but the cash flows, the items related to how much I expect to collect, 632, how much I expect to pay, here we go, how much I expect to pay for raw material, how much I expect to pay for direct labor, etc. Those are the key things that we want to look out for. Even if this is not a perfect estimate, at least we can see if we're headed into trouble just based on expectations. If you're going to be paying out, if you're expecting to pay out more than $632,000 in cash flows in a particular month, then you need to start thinking ahead of time. Maybe you open up a credit line or something, a line of credit, and try to see if you can get the funding ahead of time before you find yourself in trouble. And that's key. Okay? All right, this concludes the Chapter 8 Foundation 15 video.